those numbers, when you say 7-9%, right? Those numbers are jarring, but you can survive that if it comes back down to a sustainable level. But when it stays at an elevated level, not the headline 9%, but something in the 5% range, 6% range, it can really erode the buying power. All right, everybody. So today with me in the studio once again, I've got Larry Alderson, CFP professional like myself, and it's always good to get us in the room. I love talking with you, Larry. I think we have, unfortunately and fortunately, just a lot of years of experience in financial planning, investments, and we did another video talking about the importance of how things are titled. But right now I want to talk to you about when someone's investing. We've seen a lot of both ends of the spectrum, somebody staying too conservative for multiple reasons, and then also being too aggressive. So kind of wanted to break that topic with you today and break it down, because I mean, we could probably throw out a lot of scenarios that we've seen in real life kind of blow up and
That's right.
Sort of backfire from what they intended. So where do you want to start? You want to start on the conservative ones?
Yeah, probably. I think a lot of our clients think that being conservative is a good thing. And in a lot of ways, being conservative is good. You want to conserve things.
Right.
You don't want to be unwise with making financial decisions. So they feel that being conservative is good.
Right.
So
and it can be.
That's right. Sometimes. But really the point of it is that you want to be diverse. So it's not that you want to be completely aggressive or completely conservative, but you want to split some things up, because if I've seen people where they've maybe inherited wealth and they weren't accustomed to wealth. So whether it was because they were young or whether it was because they never had wealth or never were around it, and all of a sudden they come into wealth, or maybe they get gas money and they want to be conservative. Or sometimes if they were in the market, they got burned by the market in their mind, and so they never want to go there again, and so they want to be very conservative. They don't ever want to see the value of their account drop ever at all under any circumstances. Right. And the problem with that is inflation.
Sure.
I mean, and we've just kind of come through a period of time that feels unusual, but in the scope of history really isn't all that unusual.
Right.
We had that spat here in the last couple of years we had one period of time where it was 9%, but then it's kind of quickly come down from that, but it's still staying pretty sticky at 3 to 4%.
Right.
But for the last 20 years, we've had hardly any inflation.
Yeah.
And we all
should probably
say
interject that we're at the end of April of 2024 while we're recording this, in case someone's watching this a year from now.
Good point. But for the last 20 years, we haven't had a lot of inflation, although prices continue to go up. I mean, we always say, I know a lot of us think, maybe with some suspicion with the government says inflation was low. Well, everything kept going up, right? So, but it really wasn't as high as it had been like in the 70s or early 80s. And so what we have seen is things return a little bit to some situation where prices were going up. And if you were conservative with your money and it didn't grow as fast as the inflation, you're actually losing money by not making enough.
Right. Yeah, in a quick and headline kind of spike in inflation like we saw maybe 12 months ago, 18 months ago, those numbers, when you say 7-9%, right, those numbers are jarring, but you can survive that if it comes back down to a sustainable level. But when it stays at an elevated level, not the headline 9%, but something in the 5% range, 6% range, it can really erode the buying power. And especially for those that are not making, 6-7 figure incomes, which most people are not making 7-figure incomes, but for the average families out there, that just erodes your buying power and just changes your perspective on life.
For sure. And so you can be conservative and you never lost any money when the statement comes, but your purchasing power has decreased. So you haven't lost any money on paper, but the practical use of the money has gone down.
Right.
And so that's a real risk if there's no component to the person's financial picture that has the possibility of outperforming or at least keeping up with inflation. That's a real problem.
Right. Yeah. So how do you address that problem?
Well, the sad truth of it is the only thing that has any history of keeping up with inflation are types of assets that are not all that super predictable on a day-to-day, week-to-week, month-to-month basis. Things like the stock market, things like real estate. And real estate is a bit of a problem. It's a good asset, not making any more of it, as everybody always says, but it's kind of hard to take a shovel full of dirt to the grocery store. So you have to, it's not easy to, so you have to have a component of the portfolio that is at least looking towards growth.
Yeah. I can get anecdotal, but I can remember, I think when you have diversity in whatever your assets are, wherever they're invested, I think it helps you weather the storms. And what I mean by that is I had a gentleman years ago, had all his money in one stock. And that's really what had built his wealth over time. But, basically it's a company plan. He didn't have a chance to really change it. So he was a benefactor of being overly aggressive, if you will. And then in retirement, the market had in his brief retirement, right out of the gates, had a very rough ride with some volatility in the market. And to be quite honest with you, it was before he was even my client. He was probably way too aggressive. And so when he came to me, he had been beaten up in the markets, and he had also been paying attention more than he ever did before, which I think a lot of retirees do right out of the gate.
Sure.
And he had said to me, which was a nice compliment, he said, I feel like since we've been working together, he said, compared to the other ride I had with this other person, I feel like you're just a really honest person, and I feel like you have my best interest. So if you can't make this work, then I'm just going to put it all in CDs. And it worked fine for a while. Then we had another, 2008 kind of substantial risk in the market and a lot of volatility. And he just said, I think you're awesome. I know you're working hard for me, but I don't like to see losses. And I'm putting everything in a CD. And that was really what made his retirement take a substantial shift in the wrong direction. Yeah. Because if he had just stayed there and at least done what we had talked about, and we knew that this was part of our plan, but at the moment of like the peak of volatility, he had just been pushed too far. And he said, I nothing against you. I'm just going to tuck it into a CD. And those CDs never recovered where he needed to.
Right. And so that's a big risk is and trying to figure out that I think all of our advisors try really hard to have these honest conversations about what it would look like, what a portfolio would look like in 2008, 2009. People don't want to be flippant about that. Don't answer the question that you think that you want us to give. So if one of the ways we can limit that volatility is by not playing the game with the entire piece. We can carve it up and keep some of it out of the game. Yep. But that's our job, is to try to come to a spot where we're at some sort of a balance of not being too conservative, but not being too aggressive either, and trying to hit that balance that people can tolerate. Mm-hmm. We don't care if they put any money in the stock market, if they don't need to think, if they've got $10 million and they don't they don't need to take risk. We don't care, right? We'll put their money all in CDs and we're happy about that. But it's just not feasible for most people to not take any risk if they want to live any kind of a reasonable retirement and be protected or being conscious of the possibility of inflation.
Yeah. I mean, think about just life in general, right? Across the spectrum. Every day, like we're taking risks every day. It really doesn't matter. Even if you put everything in a CD at a bank, there are still risks, and maybe not with your portfolio per se, but just with your house, you insure against that risk. With your car, you insure against it. There's still a risk you could get in an accident and die in a car, right? So it's not like you can ever be completely protected against risk. I think most of our job often lies in helping folks really understand that risk. And the gentleman I just described, he wouldn't even be in the situation where he could afford to even retire if he didn't take 30 years of risk by having it all in stock.
Mm-hmm.
And that really benefited him. And during those 30 years, there were times where that portfolio, his 401k, got knocked down dramatically, but he didn't have any control over it. So to him, it was just like, oh, well.
Or sometimes they don't even look at it because he's going to get up Monday morning and go to work anyway.
That's right. Yeah. And there's definitely a difference. This is in mentality. When you're earning money every week, you feel like you can weather those downturns. But once you're on a fixed income and you're just staring at your account, the anxiety can tend to get ramped up if you don't plan for it.
Yeah, and I know this isn't necessarily a plug for the Stonehouse portfolios, but
it can be, brother.
Well, the flex option that we have is a risk mitigation device for times like 2008, 2009, when volatility goes crazy, and it really is a fantastic. The back testing on it, the real life testing on it, the back testing that's been done on it, I think it brings a lot of value and a lot of comfort to people as they enter retirement, because you said it perfectly. When you're not generating that paycheck week to week, then Stonehouse is trying to generate your paycheck. Mm-hmm. We've got to be very cognizant of these movements and how to protect.
Yeah. And it's kind of, for those people who may not be aware of Flex, I'll just look at the camera here and just say our Flex option is something that we can add to most of our clients' portfolios. It's not an additional cost. It's just sort of a different way to manage a piece of that portfolio. And what it does is it kind of works like a circuit breaker, where we can take a portion of your money that is in the market, and when things get volatile, when certain indicators that we pay attention to start to trip, we pull that money up, 20%ish of your portfolio to the sidelines, tuck it into a money market for a time until those indicators start to come back in more of a green light, if you will, and then we can move that money back. It's not on a daily basis. We do it. It's really hard to predict how often we'll do it in a given year, maybe a couple times, but it's sort of a way to take a little bit of risk off the table, sort of smooth out the volatility. That's the goal of it, at least.
And very important as we're taking distributions out of a portfolio, because if you're selling out of a portfolio that's down, you're having to sell more stuff to do that. So it's a great way to avoid that.
Yeah. What about examples that you might have of somebody who's been overly aggressive?
Well, your friend is one of those or your client that talked about how they will often see people like that are in a position that they got to where they got by being concentrated in one stock, they'll maybe feel that loyalty to that, and they don't ever want to sell it.
Right.
And we can go down through a list of companies that have fallen on hard times, and if the company doesn't stay the same. The business they're in doesn't stay the same. The people running it don't stay the same.
For sure.
So it's an awful lot of risk to keep all things concentrated in one company. Sometimes it's an inheritance. I've had people sit in my office and say, my father gave me this stock and he told me to never sell fill in the blank stock because it's always been good to him.
Yeah.
Well, that's an awful lot. And then whatever, that was quite often the case with bank stocks. And then you mentioned 2008, 2009, that was a banking crisis.
Yep.
Some of those banks don't exist anymore. And some of them got bought for 10 cents on the dollar during that time period. And those people that were very wealthy aren't anymore because of that concentration.
Yeah. What was I'm not sure who made the quote, but it was invest in a company that can be run by an idiot because at some point it may be happening. But
well, and to that end, and sometimes that happens with business owners too. And I hesitate this because as a passive, we manage passive investments. We manage stocks and bonds and mutual funds and CDs and annuities and money markets and things like that. Our clients don't have to really be involved in any of that. We can't make as much money as a very good, well-run, successful business can make with an investment. But they have to go make it, and they have to. There's a modicum of luck in running a successful business, and it can go really well and it can go really bad.
Yep.
And one of the things that we've seen over the years is people just plow all of their profits in a business right back into the business, and then sometimes through no fault of their own, that business is not successful anymore. Yep. And then they've put all of their eggs in that basket.
Yeah. Yeah, it's actually a really good point because we work with a lot of small business owners, and some of them aren't so small anymore, but I've seen real good business owners do a good job of, I'll take the stone business, for example. I remember one guy saying to me years ago, Bob, do you have anything he said, I could take $1,000 and spend it on a pallet of stone. That's not the right number, but I could put all these pallets on my truck and go sell them for probably twice what it cost me. Do you have anything like that? And I was, no, nothing guaranteed is guaranteed or close to that as that. I just don't work in that environment, but you do, and that's great. But eventually there will come a time where you won't be able to sell that for that amount, that kind of margin, or it just, the business changes where that option is not there.
Or you won't be able to go do it.
Or exactly. Yeah. Further on. Yeah, exactly. And then, but what I've seen where I think real smart business owners, they recognize that. And so they set up other accounts, more financial based accounts where we can get involved, and they just take a portion of profits each year, fund that. They do stuff for their employees, but then what that does is it builds them flexibility so that eventually when you have those dark times, I know Bill Rourke's been on here, he's talked about that, enjoy the good times in your business because there will be dark times again. And if you're smart, you can tuck some away and then use that extra to help. You'll have a business decision. If your industry, your business goes through a tough time, you need to have a decision, an honest conversation with yourself and or your advisors or partners and say, we have other money that we put off to the side. Is it time to reinvest and reinvent what we're doing? Or is it time to close the business and move on to something different? And you have that flexibility because you saved a little bit off to the side.
They call that planning, don't they?
Planning and diversity. Absolutely. Yeah. That's really fun. That's like the fun part. I love that kind of stuff.
I love it.
Yeah. It's challenging, and every business is different and every owner is different. So it's a fun part of the job.
And it's a tough conversation with a lot of business owners because they're passionate about their business, or they probably wouldn't be doing it.
Yeah.
And so they really want to believe in it, and they really do believe in it.
Yeah.
And so to try to get them to, sometimes it's a challenge to get them to take that kind of advice, to take a piece of the profits. Because boy, if I just had this extra piece of equipment, or if I had this extra tool, or this extra staff or whatever.
Yeah.
So it's a temptation, but that's our role, is to have those challenging conversations.
Yep. That's why I give kudos to Ben Denault, who does our Stonehouse tax office, right? And he runs that whole team. And I give kudos to him because he's one of the few accountants out there that I think really buys into the fact that, hey, if you have a profitable year and you're going to owe tax on that, instead of buying a piece of equipment just to save taxes, you could invest it, some of that, to save some money over here for those rainy days. It doesn't always have to just be buy something, right? You could invest in something and have the same net change to your taxes. So I think accountants are usually they're judged on the bottom line. You want to keep your tax bill as low as humanly possible. And as advisors, we're judged more on years and decades, making sure that they're heading in the right direction. So it's kind of good to balance them both. What else are we missing on diversification between being too conservative or being too aggressive? Or any last messages or thoughts you have on it?
Balance. I think it's interesting, I think, to put a kind of a capstone on the whole topic. It's really, life is about balance. And not to be religious, but King Solomon was a historical figure, not just a religious figure. And he even wrote in Ecclesiastes somewhere around 4,000 years ago, I believe, divide your portion to 7 or even 8, because you do not know what misfortune may befall the earth. And that's diversification.
I mean, King Solomon, ladies and gentlemen, the world's first financial advisor.
He was widely known to be the smartest man at the time, and he had it figured out then. And our job is to understand the complicated nature of this world and what that kind of diversification and what that kind of dividing your portion, what that looks like and how it works.
Yeah, our job is to sort through the noise and get to some solutions for whoever we're in front of.
For what's practical.
Yeah, I love it. Larry, I knew it would be fun talking to you. I appreciate it. I'm trying to think of a cool name, like Life with Larry or something like that.
My wife would tell you that's not all it's cracked up to be, probably.
No, that's how you can't say that. No, I really appreciate your time. I know you're busy, and I know you run into appointments after this. So thank you very much for coming in here today.
Thanks for having me.
And I'm definitely going to drag you back in here because it's just great to talk to you, and you've got a lot of experience. And I think experience makes a world of difference.
Happy to do it.
All right. Thanks, man.